All right, so we'll start our second session today. On this session, we're going to look at chapter number 4 and 5. So we can see here we have total 8 chapter to complete, and we have done chapter 1 to 3, and chapter number 4 about accounting for the VAT, and obviously accounting for the VAT is all about how we're going to record the VAT in different circumstances. This chapter is quite important, and chapter 5 is like kind of VAT return. Here we're going to look at the VAT return, the boxes. So you're going to look at the different boxes, and individual boxes we need to see what type of thing we're going to record on the boxes, and obviously we're going to look at in detail. So if you have any question, we can take later on. For the time being, let's focus on the session. So let's move on to our chapter number 4. Chapter number 4 we have here, that is accounting for the VAT. All right. So this is our chapter number 4, accounting for the VAT. Let's look at the chapter overview, what we're going to look at from this chapter. Let's talk a little bit before we go inside of the chapter and going to do question. So let's explain a little bit what is it and how does it work, what is all about the accounting for VAT. The first thing we can look at here, VAT record and the invoice. Now, VAT record and invoice. Few things you have to remember, even though it is not relevant to the exam, but it will be helpful for your learning purpose. Sometimes we have a invoice that is not a VAT invoice. Now, for example, the invoice is sent by the supplier, but it says it's not a VAT invoice. So if you work in accountancy sector, you will see this thing like sometimes some invoice say it is not a VAT invoice. The reason it says sometimes when you buy something, maybe until you make the payment to your supplier, he don't want to give you the VAT invoice. The reason is, for example, if you order something and if you didn't pay for that, or if after that you return, or for example, for any reason you don't have a credit agreement to your supplier, and they said, I cannot give you the VAT invoice, I'll give you an invoice, but this invoice will not, you cannot use this invoice to claim the VAT. Now, what is the reason behind? For example, let's say if we like to buy some computer from Dell, and if we order let's say 500 piece of computer from Dell, and the Dell said, sorry, I cannot deliver you 500 computer because I don't know you and I don't have any credit agreement with you. So when a supplier have a credit agreement with the customer can only order up to that credit limit. And once the product has been delivered to the customer, then the supplier send the invoice, and the customer normally have 30 days to make the payment. But it is also possible, maybe you are a very new customer for that supplier and you want to buy something, and the supplier said, I don't want to deliver you because I don't have any credit agreement with you. So what happens if you don't pay later on? In this case, they send invoice, but it is not a VAT invoice. So it says like clearly on the invoice, it is not a VAT invoice. Sometimes we called it pro forma invoice. So sometimes if you look at the invoice, it says pro forma invoice. Pro forma invoice means this is not a VAT invoice. So all you have to do as a customer, if you look at the pro forma invoice and you need to make the payment. So in this case, is a little bit different. Normally what happens when you buy the product, and after that we receive the product, then we receive the invoice, then you make the payment. But with the pro forma invoice, that means I don't know the customer. For that reason, I cannot offer you the credit. In this case, the customer need to pay upfront. So the supplier said, I can only deliver the product or services to you after you make the payment, because I don't know you, I don't have a long-lasting relationship with you, I don't have any long-term relationship with you, so I can only deliver you the product once you make the payment. And the customer said, listen, okay, I'll make the payment first, but I need an invoice. How I'm going to make the payment? Then the supplier said, okay, I'm going to send you an invoice, but it's not a VAT invoice. It is a pro forma invoice. So after the supplier issued the pro forma invoice to the customer make the payment and tell the supplier, like, I have made the payment. Can you send me the VAT invoice now? And the supplier will say yes, because you make the payment. Now I can give you the VAT invoice because you can claim back your VAT. This could happen sometimes in your workplace or somewhere. It is not necessary every time the supplier have to issue the VAT invoice. So with accounting record, we have the VAT invoice. Now the VAT invoice, remember that VAT invoice, there are a few things the invoice definitely have to have before we say the invoice is valid. For example, the VAT invoice have to have the date. If there is no date on the invoice is not valid. Remember that. Because if you keep buying the same product from the same supplier, it is possible you might use the same invoice to claim the VAT a few times, and this is not correct. For that reason, it is possible the customer can use the same invoice few times to claim the VAT. For that reason, every single invoice, there should be a date. If there is no date, this invoice is not valid. That's the first thing. The next thing, the invoice should have the supplier VAT number. Remember that invoice should have the supplier VAT number. So if the supplier send a VAT invoice to me, the supplier VAT number should be on the invoice. So it is not necessary, the supplier don't have to include the customer VAT number on the invoice, because invoice is sent by the supplier to the customer. For that reason, the invoice should only contain the supplier invoice. That's the first thing. The next thing is, like, the amount has to be VAT excluding. For example, let's say if we have invoice, and in this invoice, let's we buy 100 pen. So 100 pen, and if each pen is £1, so multiply by 1, it should be £100. And this is the VAT exclusive amount. Remember that, VAT exclude or exclusive amount. And after that, with the net amount, we charge the VAT 20%, let's say £20, and that's make total 120. That means this £100 has to show excluded. So all the product and all the services we're going to provide to the customer, the price has to be VAT exclusive in the invoice. So we don't show the VAT inclusive price. VAT has to be charged separately, so that I understand in this invoice, I have a £20 VAT. So this is the next condition. The final condition here we have here, if there is any discount, for example, we have a different type of discount. We have a trade discount, and we have a bulk discount, and we have a settlement discount. Remember that only the trade discount and the bulk discount need to show on the invoice. You can only show the trade discount and the bulk discount on the invoice. Do not show the settlement discount or the prompt discount on the invoice. Remember that, because prompt discount or settlement discount, we have no idea the customer going to accept it or not. We have no idea. For that reason, we do not show the settlement discount on the invoice. What do we do for that? For the settlement discount or for the prompt discount, we issue a credit note to the customer separately, including the VAT. For example, if I said, if you can pay within 7 days, I'll give you 5% discount. So if the customer decided to take this offer, so what will happen? I'm going to issue a credit note to the customer, and in this credit note, I'm going to show 5%, and this 5% has to be including the VAT, because all the discount has to be on the total amount, not the net. Very careful with that. So this is the first thing we're going to look at. The next thing we have here, simplified or modified invoice, an electronic VAT invoice. Nowadays, almost every company, they use the electronic invoice. So if you use the QuickBook or if you use the Xero, all the bookkeeping software, they have a facility to send the electronic invoice to the customer, and you can track the invoice. So nowadays, it's not important you have to post the invoice or physically have to print and give it to your customers. You can use the electronic. it have no implication. There is no problem from the HMRC point of view. You don't have to print it out. There is no regulation. Every single invoice has to be printed. So you can keep, on your cloud or somewhere as electronic copy. There is no problem for that. The simplified invoice is all about when the invoice amount is less. When the invoice amount is £250, including VAT. £250 including VAT. When the invoice amount 250 and inclusive VAT 250 total amount, you really don't have to make like detailed invoice. So you can make a small invoice and it's like a receipt with the VAT number of the supplier and just amount and how much is the total. So you really don't have to make all the customer address, supplier address, the VAT number, and the description, the discount. You don't have to make in detail. So you can make a very simple invoice, and we called it simplified invoice. The reason we called it simplified invoice because it's make it simple. So you make it very simple way so that you don't have to go in detail like a VAT invoice for the big amount. So when the amount is £250 or less, you can use a less detailed invoice, and we called it simplified invoice. We're going to look at some example how the simplified invoice look like, and obviously like in the exam, there might be a question for the MCQ type question. They might ask you like how much is the amount. So the most tricky question in the exam I have seen, they tell you like £250, you can use a simplified invoice, but rather than they saying inclusive VAT, they said exclusive VAT. Exclusive VAT. So without VAT or the net VAT, you can claim £250 as a simplified invoice. The answer is a no. It cannot be more than 250 including the VAT. It cannot be more than 250 including the VAT. So it has to be including VAT, not excluding. Very careful with that. The next thing we have here, reverse charge and the CIS. So we're going to look at this one, how we do the construction industry deduction. So CIS is not very common for everyone, but obviously it is important for the construction industry. Now in construction industry, we know like they use a subcontractor. So for example, one person take the contract for the whole building, and there's a lot of people work under him as a subcontractor. So someone gives some brick, someone give the cement, someone do the paint. So there's a lot of subcontractor. Now, most of the people, they come from the Eastern European country, and what they do, rather than they become employee, they become subcontractor. And for the construction industry, the rules is a little bit different than if we have a normal employee for any company, because they have to make a deduction 20% if they're registered subcontractor. If they're not, they have to give 30%. So the main contractor, they deduct 30% from their salary and they gave it to HMRC. The reason is before, so many people used to come here for the work as a subcontractor for the construction industry. They work 6 months or 5 months, 3 months. They took the money and they went back. So they never pay any tax to HMRC. For that reason, the HMRC said, no, it's not going to work. So every time when you take a salary, we'll deduct 20%. And at the end of the year, after April, we're going to see how much you have deducted or how much you're supposed to pay. And then we make the calculation. If we need to give you back, we'll give you back. Otherwise, we have to pay back. So there's no way you can go back. So that's the reason the construction industry calculation is a little bit different. Discount, we said like we have two types of discount. We have a credit discount, we have a bulk discount. Then we have a credit and debit note. So we'll need to look at that. Credit note normally is for the return. Debit note is not very common. We hardly use the debit note, but the credit note is all about when we make a return. So for example, either my customer return to me, I have to send a credit note to them, or if I return to my supplier, they will issue the credit note to me. So credit note means return. Now remember, every single credit note contains the VAT. So when you have return, there's a portion of VAT inside that one we have to consider. Next one, we're going to look at the tax point. It's a very important. In the exam, you're expecting 15 marks from this point only, tax point. So you need to make sure like you revise it very well. 10 to 15 marks will come from the tax point question. Now let's talk about what is the tax point and how does it work. Tax point is all about when you're going to tell the HMRC, I have income. Now, for example, it is possible you take a contract. Let's say you take a contract for a house. You want to build a house, and to build a house is take 1 year. Now, let's say in January you took the contract, and the house will take 1 year to complete. Now, which point, because the VAT has to be submitted every quarter, so in which quarter are we going to submit the VAT for that house, for that contract? Let's say the contract was for £100,000. So in which point you're going to pay the VAT on that? At the beginning, at the middle, at the end, when? So this rules is basically explained on this tax point rules. So here we're going to look at like when actually I need to tell the HMRC, so this is my income from that contract. And also what happened because of the contract if I take a deposit. For example, if I take a contract and the customer said, okay, I'll give you 10% deposit, or if I said like you have to give me 20% deposit, and after that, when the work is 50% done, you give me another 50%. When the work is 70% done, you give me another 70%. So when you're going to record from the VAT point of view, we're going to look at from the tax point rules. And finally, you have a bad debt relief. Bad debt relief. So what happened if my customer never paid to me? So as we know, when you make a sale, we have to pay the VAT regardless the customer paid to or me. So still I need to pay the VAT. According to the HMRC, we follow the accrual concept. And according to the accrual concept, if we make a sales, we have to record the sales. And as soon as we make the sales, we have to pay the VAT. Even though my customer going to pay me after 1 month or 6 months, but HMRC said, no, pay the VAT now. And when your customer pay you, you keep everything by yourself. But now you make a sales, pay the VAT now. So you really don't have to wait when your customer pay and you pay the VAT. So you have to pay the VAT now. So what happens if you make a sales and you pay the VAT to HMRC, and after 2-3 months, your customer said, sorry, I cannot pay you, I'm bankrupt, this and that. So this sales become bad and it's a bad debt. So if there is a bad debt, so the rule says you have to wait 6 months. 6 months from the day invoice was due. For example, you should invoice on 1st of January, and the invoice was due 30th of January. So from the 30th of January, you have to wait 6 months. And after that, you can claim this bad debt relief. So you're going to look at that rules as well. So this all we're going to look at from chapter number 4. And we're going to do all the activities we have, and we're going to discuss in detail. And hopefully, if you have any question, we'll take from there. So before you start, we'll take a 10-minute break just to break your fast. So if you're fasting, you can break your fast. And by the time, 10 minutes after, you're going to come back and we'll start again. So I'll see you around 6:35 or 40. We're going to see 10-15 minutes. So we'll say like there's a 10 minute or 15 minutes. So 35 or 40 will come back. And we'll start with our chapter number 4 from here. All right, so if you go inside of the chapter now, so we'll see what we have discussed. Let's have a look what we have there. And we'll try to do a few questions together, and we'll see how much you understand from here. Now, the invoice, more or less all of us, we have seen how the invoice look like. So if you look at this invoice, this is one of the template of the invoice or pro forma of the invoice, and you're going to look at the real invoices look like that. Normally, the invoice in the middle top is written as invoice, and on the top, either it could be the right or it could be the middle. You will have the supplier detail. The supplier detail normally is in the middle or on the right side of the invoice. On the left corner, you have a customer detail, the person who buy or make the order. And you can see this is the detail of the supplier. And this VAT number is the supplier VAT number. For the customer, we just need their address. We don't need their VAT number. We just need their address. Then you have invoice number. Then you have a date. Then you have a description, the quantity. What did you buy? stock unit price, this unit price without VAT, the net amount, the total, and after that we add the VAT. Just give me the subtotal that the customer need to pay for this invoice. So it's a normal invoice. The way invoice look like same. So there's nothing new here. Let's have a look. Here more thing. Okay, let's look at our first activity we have here. Activity 1. It says valid VAT invoice. Valid VAT invoice. Using your AT reference material, which 3 of the following item must be included on a valid full VAT invoice, not simplified, full VAT invoice. So from here, which 3 information must have to have on the VAT invoice? So I'll give you 1 minute, take a look, and ask me which 3 has to be on the invoice. So the first one you can see here, we have a customer VAT registration number. Do we really need the customer VAT registration number on the invoice? Yes or no? So we really don't need that, isn't it? So we really don't need the customer VAT number on the supplier invoice. We don't need that. Supplier VAT registration number, definitely we need that. Without the supplier VAT number, the VAT invoice will not be complete. So we said supplier VAT registration number, yes. Total VAT exclusive amount, yes, we need that. Remember that we need total VAT exclusive amount. That means without VAT, how much is the amount? So total VAT exclusive amount. Total VAT amount charge, yes. How much is the VAT we are charging on this invoice? We need that as well. So total VAT amount charge. And finally, total VAT inclusive amount. No, we don't need the total VAT inclusive. So we have 2, 3, 4. So number 2, number 3, number 4. Very good. All of you give the right answer. Very well done. Naira, Elizabeth, very well done. Goodwin, very good. So you understand that what information have to have on the invoice. All right, let's have a look at the next one. The next one is all about the credit note. So let's have a look. It says, processing a VAT invoice will have an impact on the VAT control account and therefore will impact on the amount of VAT payable or reclaimable by the business. Purchase invoices and a purchase return will affect the input tax, and sales invoice and sales return will affect the output tax. Remember, that is very important to understand. If I make a sales, that is output VAT. And if there is sales return, it will decrease the output VAT. Remember that it will not have impact with the input. So it's not like, for example, I buy something, I sell something and I have output VAT, and I buy something and I return, I adjust with the output. It's not going to work. Remember that the output VAT link with the only output. For example, when I sell something, if I have output VAT, if the customer return to me, I'm going to minus it from the output VAT. I'm not going to link it up with the input VAT. On the other hand, if I buy something, so my input VAT will go up, but if I return something to my supplier, then the input VAT will be reduced. So the input VAT and the output VAT is two completely different things. There is no relation with that. So they don't have any relationship. So make sure like you don't mix it up with that. For example, this question, it says a purchase invoice. Remember that as soon as you see the word purchase invoice, that means the purchase invoice is linked with the input VAT. This will have no relation with the output VAT. So purchase invoice for the taxable supply has been processed. So purchase invoice for the taxable supplies has been processed. What will be the effect on VAT? Choose one answer. So what do you think? What will be here? So it's a purchase invoice and the invoice has been processed. So purchase invoice for the taxable supply just has been processed. So I buy something and I receive the purchase invoice. So what will be the impact? Input tax will increase, input tax will decrease, output tax will increase, or output tax will decrease. So what do you think if I buy something, and what will happen if I have a purchase invoice? So if I have a purchase invoice, it is linked with my input tax, and my input VAT will be increased. Every time I buy something, remember that my input tax will go up. Every time if I return something, that input tax will go down. If I sell something, my output tax will go up. If my customer return to me, then my output tax will be reduced. And how do I know my customer will return to me? With the credit note. Okay, let's have a look. The next one is all about the simplified invoice. So let's have a look. Simplified invoice. Simplified invoice is all about if the total supply invoice is less than 250, including VAT. So it has to be like 250 or less. Even if it is 250, you can still use the simplified invoice. The question said less than 250. It doesn't mean like if what happened is 250. So 250 or less. But it has to be VAT included. A business may issue a less detailed simplified invoice. Supplier do not need to keep a copy of the simplified invoice. So if you are the supplier, you don't have to keep the record of the simplified invoice. But if you are the customer who buy the product, if you want to claim the VAT, you have to have a copy of that. Although the customer would still need to keep the invoice if they want to reclaim the input VAT. So if you want to reclaim, you have to keep the copy of the VAT. The next one we have here, if the expenditure is 25 or less, including the VAT. If the amount is 25 or less, including the VAT, then what will happen? You don't need an invoice for that. For example, if you pay for the parking, if you pay for any small expenses where you need to just get the receipt, you don't need an invoice for that. So then no invoice is required to reclaim the VAT, but you have to keep the receipt. So simple receipt is acceptable. For example, telephone call, for example, purchase made through the coin operating machine. So you can use that if it is less than £25, including VAT. All right. Then we have invoice where reverse charge apply. So let's read quickly this one. If an invoice is to be issued where a customer will account for the VAT by reverse charge, the seller will not charge VAT on the transaction. Example, they will ignore the usual VAT rate applied to those supply. This is the case, as you saw in chapter 3, where service are supplied overseas to a VAT registered customer, but also applied to most construction service in the UK. Where the service is provided to a customer who is registered under the Construction Industry Scheme, CIS, it is a little bit different than the normal business. This is called a domestic reverse charge. With a domestic reverse charge, the following detail must be included in the VAT invoice. A note to make it clear that domestic reverse charge applies and the customer is required to account for the VAT. Then clearly state how much VAT is due under the reverse charge and the rate of VAT if the VAT amount cannot be shown, and the legal wording to reference the reverse charge applying. For example, Reverse Charge VAT Act 1994, Section 55A applies. Now this one, you don't have to worry about this thing. In the exam, you're not going to see any CIS question, so you really don't have to worry about that. But for the CIS company, Construction Industry Scheme, the way we calculate the VAT for them and calculate the tax for them is a little bit different than the normal company, because if you are a CI registered business, you have to deduct the 20% from all of your subcontractor and the 30% if they are not registered with that scheme, and later on you have to claim the money back from HMRC, or you have to pay to HMRC if you have a balance the difference. But CIS is not very common in this exams. It's just a little bit they'll give you what is CIS, but you're not going to see any question in the exam for the CIS. Let's have a look if you have any question, and we can see what is it more. Okay, the next one we have activity 3 says reclaiming input VAT. Decide whether the following statement are true or false. Tick the relevant box below. A simplified invoice can be used to reclaim input VAT, true or false. They said simplified invoice you can use to reclaim the input VAT. So if the amount is less than £250, we can always use the simplified invoice to reclaim the VAT. That's true. So there is no problem for that. As long as the amount is less than 250, including the VAT, we can always use that simplified invoice to claim the VAT. On the other hand, we have no VAT invoice is required to reclaim VAT on a car parking charge over 50, including the VAT. True or false? It says like we don't need the invoice to claim the VAT on the car parking if it is £50, including the VAT. That's not true, isn't it? If it is 25, including the VAT, then you can use it. But if it is more than 25, then you have to use the invoice, not the receipt. So it's a false. All right, let's move to the next one. In the next one, we have here VAT and the discount. Now we have two types of discount. We have a trade or bulk discount, and we also have a settlement discount, that one we call prompt discount. Now, trade discount is the discount that one business gives to another business to make some profit. For example, when you buy something from one business, and this business said like, okay, this is the price, but I'll give you 10% trade discount so that you can make some profit when you sell this product to your customer. On the other hand, the company can also offer the bulk discount, and the bulk discount is all about when you buy a large quantity. So we know this thing from our level 2 study. It's not a very difficult thing. The settlement discount or the prompt discount is the early settlement discount. So normally the invoice have 30 days to make the payment, but if the supplier want the payment early, then the supplier can make an offer to the customer. The supplier can say like, if you can make a payment within 7 days or 10 days, I'm going to give you 2% or 5% discount. So in this case, like we called it settlement discount, but this is just the offer to the customer. It's up to the customer going to accept it or not. So if the customer think like the customer already have the money, so he can pay, take the offer, so they can take it. And if the customer feel like I don't want to take it, then absolutely fine. So what happened with the settlement discount? So after sending the invoice to the customer, if the customer think like they want to take the offer, they can pay the less amount, they can minus the settlement discount, and they can pay you less money that is not matched with the invoice because they took the discount. Or the customer can call you and say like, I'm paying the full amount, but can you issue the credit note? Or the customer can ask you the credit note first before they make the payment. So anything could happen. But remember, if there is a settlement discount, we always need to issue a credit note to the customer with the VAT. For example, if the total amount was 1,000, and if we offer 10% settlement discount, so this 1,000 plus the VAT 200, for example, is 1,200 total. So the discount will be 10% on the 1,200, not in 1,000. Remember that, not on the net, on the total. So if I make 10% of 1,200, so let's say it is 120. Inside of the 120, we have £100 net and 20 is the VAT. So that means net plus the VAT. Remember that. All right, let's read this question. Is a business sell good for 1,000 plus VAT, but allow a settlement discount 5% for the payment within 10 days? The customer pay after 8 days. So the customer took the offer because customer paid after 8 days. That means the customer took the offer. The trader had decided to invoice for the full amount only. So the supplier, he sent the full amount invoice to that customer. So obviously, if they normally they do full amount invoice because until the customer accept the offer, we don't know they're going to offer it or not. I can offer on the invoice because this offer go with the invoice. Under the invoice, we write a very small letter. We say like, if you can pay within 10 days, we'll give you like 2% discount. Sometimes we write 210 net 30. 210 net 30. 210 net 30 means if you can pay within 10 days, you'll get 2% discount. So 210 net 30. Otherwise, you can pay in 30 days. So you will get 2% discount if you can pay within 10 days. And otherwise, you can pay 30 days. There's no problem for that. Normally, some invoice, you will see there's a 210 net 30, or sometimes they write it down, the settlement discount offer a 5% if you can pay within 10 days. Right, I have a question from Joy. Does the customer have to get a credit note if the settlement discount is taken, even if the system allows settlement discount to be taken on short? Yes, because in future, if you need to have a paper like the credit note from the supplier, then you should have a copy of that. Now, for example, the invoice is offered settlement discount, you make the payment, but actually you don't have a backup evidence like you have accepted the offer and there's a credit note. The supplier definitely have to issue the credit note to the customer if there is settlement discount taken by the customer. All right, so if you look at the next one, is what is the correct action for the trader? So what the trader will do now, if the customer accepts the settlement discount, issue a further invoice for 50 plus VAT. We don't do that, isn't it? Because we already issue the full invoice. So we're not going to issue another £50 invoice. Issue a credit note for 50 plus the VAT. That's a look like more correct, because we need to issue a credit note for 50, because 1,000 times 5%, it is 50. So issue a credit note for 50 plus the VAT. Remember that it always has to be VAT. We need to add, because the discount is always given on the total amount, not on the net. No action taken, that's not right. Issue a credit note for 50 including VAT. No, we never do that. The VAT always has to show separate, never including. So this look like more relevant answer. All right, let's move to the next one. Then we have activity 5, the credit note. Let's look at this one. It's a business issue a credit note to a customer. Remember that if the business issue a credit to a customer, that means the customer returned to me, and that's why I'm issuing the credit note. The credit note is only issued when the customer returned to me. So if the customer returned to me, I have to issue the credit note. So what will happen if I issue the credit note? My input tax will increase. Remember that credit note is linked with the sales. It's a sales return, so no relationship with the purchase. And if it is not linked with the purchase, that means no link with the input VAT. So we don't have to even worry about the input VAT, because input VAT is only linked with the purchase. Output VAT will increase, output VAT will decrease. What do you think? What will happen? Output VAT will be increased or output VAT will be decreased for this question? So if the customer returns to me, my output VAT will be decreased, because I'm going to pay less VAT to the HMRC now. So for example, if I make a sales for £2,000 and 20% is the VAT, let's say £400. And after that, £1,000 customer returned to me. And obviously I need to give the credit note. So actually my sales is not 2,000, actually it's 1,000. So this 200 VAT, I'm not going to pay, because I will say that's not actual sell. The customer returned to me. So actually I'm going to pay VAT 200. So my output VAT will be decreased. That's correct. All right. The next one we have here is called tax point. It's a little bit tricky. So all of us, we have to be a little bit concentrate to see how we do the tax point rules. So let's have a look at the tax point. Yes, it is possible that an order could be received, dispatch, an invoice, and payment made all in the different quarter. For example, in quarter number 1, we received the order. Quarter number 2, we dispatch the product, and we invoice quarter number 2, and we receive the payment from the customer quarter number 3. Now, this is happening for quarter 1 to 3. So in which quarter I'm going to tell the HMRC that's the VAT I like to pay. So when I receive the order, when you dispatch, when we invoice, or when you actually receive the payment. So this is basically the tax point rules. So let's try to understand and let's try to focus it. So the tax point is the point when I'm going to tell the HMRC when I'm going to accountable for that VAT. Now, the tax point rules is very simple, but a little bit tricky. You have to understand it. This question will be definitely in the exam, so you need to make sure you understand it very well. So the first thing we have here, the tax point is the earliest of the following event. So the tax point will be the earliest of three events. What is the three event? Basic tax point, invoice issued, and payment received. So this is a three event, and the tax point is the earliest one. Now, for example, if the basic tax point is 1st of Jan, if the invoice is issued 5th of Jan, and if the payment is received, for example, 10th of Jan, so the earliest one is 1st of Jan. This is my tax point. Now, I want all of you to remember one thing. The basic tax point and the tax point is not the same thing. Basic tax point and the tax point is not the same thing. So tax point could be one of these, and the basic tax point just one of the name. So let's try to understand what is basic tax point. So basic tax point, basically, when there's a dispatch, when there's a good made available and the service completed, any of this happened. So if I send the goods, or if the goods is ready to give, or is available, or service is completed, so if any of these happen, then we call them basic tax point. So basic tax point means the product has been already dispatched, the service is already completed, or the goods is already available, one of these. So all these three could be just one, we don't know which one. In the exam, they might say the good has been dispatched on 1st of January. That means the basic tax point is 1st of January. If the question said like the service is completed 1st of January, that means basic tax point is 1st of January. Now, basic tax point and the tax point is not the same thing. So when you have a basic tax point, then this is number one. Number two is the invoice issued. When did you issue the invoice? And number three is the payment received. So the tax point will be one of them, either number one or number two or number three. It depends on what? Depends on the earliest event. Which one happened earliest? But there is one condition. What is the condition? The condition is if the basic tax point, the first one, if the basic tax point become the tax point, if the basic tax point become the tax point, then you have to stop and look one more thing. What we have to look? We have to look when the invoice was issued. When the invoice was issued. Now, if the invoice was issued within 14 days from the basic tax point, then we ignore the basic tax point date and we take invoice issued date as a tax point date. For example, let's say the product is dispatched on 1st January. Product dispatch on 1st of January. Then let's say the invoice is issued. Invoice issued, let's say 12th January. And the payment is received 20 January. Payment received is not a problem. If the payment received happen later, we don't have to worry about that. But only we have to look at when the invoice is issued. Now, looking at these three, which one is look like our tax point? The 1st of January look like our tax point because this is the earliest one. Between 1, 12, and 20, the first one is the earliest one is the 1st of January. So it's look like this is my tax point. Now, before I say this is my tax point, I have to stop to look at when the invoice was issued. So I can see the invoice was issued within 14 days. 1 to 12 is within 14 days. And if it is within 14 days, we have to stop. And I will say, no, this is not my tax point. So this is the basic tax point, basically. So this is not my tax point. So I'll cross this one, 1st of January. I'll say invoice issue date, 12th of January. This is my tax point. And dispatch, you called it basic tax point. So basic tax point is not my tax point, is the invoice is issued within 14 days from the basic tax point date. So this is a little complicacy or the condition that you have to remember. So let's read quickly this one. It said, if the basic tax point is the earliest date, then check if the invoice is issued within 14 days of that date. If it was, then invoice date override the basic tax point and become the actual tax point. That's it. All right, let's move to one of the example. Let's see if we understand it. All right, so we have activity 6, Alex, tax point. It said Alex raise a pro forma invoice and receive a payment in advance. Remember that pro forma invoice is not the VAT invoice, just to have the payment from the customer. I have a question from Naira. If it is more than 14 days, then the tax point is the basic tax point. Yes, that's correct. If it is more than 14 days, we don't have to worry. Then the basic tax point becomes the tax point date. Yes, that's correct. Alex raised a pro forma invoice and received a payment in advance of making a supply. The pro forma invoice was dated 18th of May. Remember that order date is, if there is an order date, it is irrelevant. Do not consider the order date. The payment was received 25th of May. So we received the payment 25th of May. The goods were supplied 29th of May, number 2. And the invoice was raised 1st of June. Remember that. Do not look at the pro forma invoice date or do not look at the order date. It is irrelevant. What is the tax point here? So what do you think? Which one is the tax point we have here? So we have 25th May, 1st June, and 29th of May. The 18th May is irrelevant. So you don't have to consider that. Out of these three, 25th of May is the earliest one. And for that reason, we have to take the payment date 25th of May. So remember, only will stop if the basic tax point become the tax point. If my invoice become the tax point, no problem. If my payment received date become the tax point, no problem. Only if the basic tax point, that is goods supplied or goods available or the service completed, if this become my tax point, then we have to check is the invoice is raised within 14 days or not. All right. Let's move to the next one. The next one is the deposit. So what happened if we receive the deposit? Remember that if there is a deposit, then there will be two tax points, one for the deposit and one for the remainder of the payment. So let's look at this one. Activity 7, B limited. For the deposit, we look for only one tax point. So what is the tax point for the deposit? And for the remaining balance, there will be another tax point. Let's read this question. So on 31st of May 2011, B Limited ordered a new equipment. Remember that order date is irrelevant. Do not consider the order date. Do not consider the order date. Do not consider the pro forma date. Don't consider all of this. So order a new printing machine and 16 June paid a deposit. The first payment received 16 June. 6,000. The machine was dispatched to be limited 30th of June. So this is the basic tax point, 30th of June. On 18 July 2011, an invoice was issued. 18 July invoice is issued. And full amount paid on 23rd of July. So first we talk about our 6,000 deposit. So 6,000 deposit we received 16th of June. And the machine was dispatched 30th of June. That means after the payment received for the deposit. So for the deposit, which one will be our tax point? What do you think? Which one will be our tax point for the deposit? We have a 16 June, we have 18 July, 30 of June, 23 of July. 16, yes, 16 of June. Remember that for the deposit, you always look at when you receive the deposit, and it's 16 of June. All right, how about this one? What is the tax point for the balance 54,000? Now we have a basic tax point. So basic tax point is 30 June. Then 18 July invoice issue raised, 18 July invoice, and the payment received 23rd July. So which one we think is the tax point? 30 of June, 18 of July, or 23rd of July for the remaining 54,000. So it is 30 of June. Why? Because this is the earliest one. And from the 30 of June to 18 of July, it is more than 14 days. More than 14 days. For that reason, I'm not going to override. I'm not going to change because it is more than 14 days. If it is less than 14 days, we have to stop and change. But it is more than 14 days, we don't have to change anything. So we'll say it is 30 of June. So where is it? 30 of June. 30 of June. All right. Any question from this one, from anyone? Anyone have any question? All right, very good. So let's move to our next one. The next one, we have a VAT on bad debt. Okay, let's have a look. We have already discussed what is bad debt. When the sales gone bad, when the customer is not paying the product or services they're supposed to pay for, sometimes they become bankrupt. So we called it bad debt. And as long as we pay the VAT, we can claim all the VAT back from HMRC. But there are a few rules that we have to remember. So if the sales gone bad, so there has to be a condition that has to be fulfilled for the bad debt relief. What is the condition? The debt is over 6 months old. So you cannot claim the VAT back until the debt is 6 months old. From which day? From the day it was due for the payment. In the exam, it could be tricky. They can give you the invoice date. Do not consider it from the invoice date. Remember that, because when you issue invoice, the invoice is due after 30 days anyway. So you have to calculate, you have to count from the invoice payment date. So if it is 1st of January, it is not counting from 1st of January. It was due on 30th of January. So you need to count from 1st of February, 6 months, and after that you can claim the bad debt relief. The date has been written off in the trader book. So obviously on our profit and loss account, we have to claim the bad debt as expense and we have to return it off. So our sales ledger control balance will have to go down because the money will not be recovered. And the VAT must be paid to HMRC. So if you never paid any VAT to HMRC, you will not be able to claim. So you need to make sure you see like the VAT has been paid. If the VAT never paid, you cannot claim it back. All right, so we have one activities here, bad debt relief. What effect will claiming VAT bad debt relief have on the amount of VAT due on the HMRC? So what effect will claiming VAT bad debt relief have on the amount of VAT due to HMRC? Now, if there is a bad debt relief, am I going to pay more VAT or less VAT? So if, for example, if I need to pay £1,000 VAT, and I have a 200 bad debt relief, that means this 200 will reduce my VAT, because I also listen, £200 I'm not gonna will not be able to recover from the customer. I'm not gonna get this money from my customer, so it's my bad debt relief. So even though the VAT was 1,000, actually I'm going to pay 800. That's my relief. So amount payable will decrease. The amount I want to pay to HMRC, it will be decrease, not increase. So bad debt relief is a relief for me. I'm going to pay less VAT for that. All right, so this is the end of the chapter. Let's move on to the next chapter. Do a few questions from there. So VAT return, chapter number 5. Let's have a look at the chapter overview. What we're going to cover from this chapter. So the VAT return, we have accounting software and they're making the tax digital. Now, this is called MTD. MTD, I'm sure all of you heard about the MTD. MTD is all about, like before, the HMRC have a website like the VAT website, the Gov website. So anyone want to submit their VAT return, they can make a government gateway ID and they can submit the VAT return on the HMRC website. But now HMRC said, listen, every single company have to follow the MTD rules. MTD rules means making the tax digital. That means you should have your own software. So that means like HMRC not helping you anymore to submit your VAT return on the HMRC website. So they said, no, you should have your software like a QuickBook or Xero. You should have your bookkeeping software. And you need to submit the VAT return from that software to HMRC. And you should have a copy of the digital, you should have a copy of all of this thing digitally on your computer, on your software. So for example, if they like to check how much was the sales, how do you claim, everything, the bookkeeping, you should have it on record. That means everyone have to pay for their bookkeeping software or they cannot actually do it. They used to do it before, just to go to the HMRC website, submit the VAT return. It's not going to work like that anymore. So this is called MTD until like it is stopped by any beliefs or any religious belief. For example, if your religion stop you not to use the computer or the software, then you are only allowed to use the old system. But if other than there is no problem, then you have to use the MTD. The MTD means like you using accounting software to submit the VAT return rather than using the HMRC site to submit the VAT. VAT control account, this one is very common for us. We have done on our level 2 as well, VAT control account. So we have a debit side and the credit side. Right hand side is the credit side, left hand side is the debit side. So right hand side tell us, for example, on the T account, all the output VAT. So if I need to pay the VAT to HMRC, I record it on the credit side. If I'm going to claim the VAT from HMRC, I record on the debit side. That means the input VAT. This one you have done on your level 2. For example, VAT on sales, then VAT on purchase return. All of this thing is a liability will be increased, so it comes to the credit side. On the other hand, on the debit side, we will have VAT on purchase, then VAT on sales return, this sort of in discount allowed, discount received will come here. So all this thing basically relevant to the VAT control account. Then VAT transaction, you have irrecoverable VAT, book of prime entry, bad debt, this thing you already know. Then VAT submission, normally the VAT submission is quarterly. Normally the VAT submission is the quarterly. Now it is possible you can do the submission, VAT return submit monthly as well, but you need to have a permission from HMRC to do that. Some cases you can do VAT monthly, but 99% case everyone do VAT quarterly. There is also possible you can do the VAT annually. We called it annual VAT return, but you have to have a permission from HMRC. There are a few conditions has to be fulfilled before you can do that. So the VAT can be submitted quarterly, monthly, annually, but 99% case VAT submission basically on the quarterly basis. For example, if my quarter is January, February, and March, so for the 3 months, the HMRC give me 1 month, 7 days to submit the VAT return. So for example, if my quarter is Jan, Feb, and March, from this day, I have 1 month, 7 days. So 1 month and 7 days. That means I'm going to submit the VAT return on April, 7th of April. No, not April, after March, April, so May. 7th of May, I have to submit the VAT return, 1 month, 7 days. if I do electronically. If I do paper-based, it is 1 month. But if I pay by direct debit, I get 3 days extra, so it's 1 month, 10 days. But normally the return online is 1 month, 7 days. All right, so let's look at what we have here. There's so much information we have here. Make sure you read all of this thing. Okay, let's have a look at activity 1. Let's have a look what we have here. Credit note impact on the VAT. A credit note for taxable supply is being processed. Credit note for taxable supply is being processed. So what will be the effect on the VAT? So who can tell me that? What will be the impact? Taxable supplies. Taxable supply means sales. Taxable supply means sales. Supply means sales. Remember that. So if we make a VAT supply, what will happen? A credit note means the customer returned to me. And obviously, if there's a credit note I issued for the taxable supply, what will happen? I'll pay more VAT or less VAT? I'll pay less VAT because output VAT will be decreased. If there is a return, I'll pay less VAT. Very good. All right, the next one we have here, recovery of the VAT. Now, in some cases, we can claim the VAT, some cases we are not. We have discussed this thing before. If you remember, we said like, if there is a car, we cannot claim the VAT. If there is a UK business entertainment, we cannot claim the VAT. For the office supply, can we claim the VAT? The answer is yes. For the car, no. For the computer, yes. For the UK business entertainment, no. So not everything we can claim the VAT. We need to remember few things, maybe we will not be able to claim the VAT. All right, let's have a look what we have here. So we have one book of prime entry. Let's try to do it together. Let's see if we remember our level 2 VAT control account. Okay, so VAT from the sales day book, is it debit or credit? VAT from the sales day book, debit or credit? Is a credit because its output VAT will be increased. I have to pay more VAT to HMRC is a credit. Very well done. VAT from the sales return day book. So if the customer returned to me, which side I'm going to record? Debit, very good. Then VAT from the purchase day book. VAT from the purchase day book is also debit, is the input VAT. VAT from the purchase return day book is a credit because if I return what I buy, I cannot claim the VAT, I have to pay the VAT back. VAT from the cash receipt book, debit or credit? Remember that it is a cash sale or credit sale, doesn't matter. You have to pay the VAT. You cannot say like, oh, I make a credit sale, I make a cash sale, no difference. You make cash sale, you make credit sale, you have to pay the VAT, no difference. From the cash payment book, if I buy a cash purchase, debit. So even if I buy cash or credit, I can claim the VAT back. All right, then we have a VAT submission period. We have talked about this 1 month, 7 days. We know this thing. So let's look at one example for activity 4, VAT deadline. So a trader prepare a VAT quarterly VAT return using the Making Tax Digital compatible software. She always pay her VAT via direct debit. Remember that the direct debit always 3 days extra. 3 days extra. That means if it is normally 1 month and 7 days plus 3 days for the direct debit payment. Okay, so here it says, select which of the following deadline apply to the submission VAT return and payment of tax in relation to the quarter ended 31st of May. So for the 31st of May, what will be the deadline? So it will be 3 days extra. So we are in May. So from the May, if I count 1 month, 7 days, so that will be June, 7th of July, 7 July plus 3 days extra for the direct debit. So it will be 10th of July. This is the 10th of July. The payment has to be made 10th of July. The question asks two things. Okay, the question asks you submission and the payment. The payment we can make on 10th of July, but the submission will be when? 7th of July. Remember that the submission deadline always fixed 1 month, 7 days. 1 month, 7 days. The submission deadline is always fixed 1 month, 7 days. If I do online, if I do paper, is 1 month. If I do paper form is 1 month, but if I do online is 1 month, 7 days. But if I pay by direct debit, I can pay by like 3 days extra, the 10th of July. But the submission always 1 month, 7 days. Do not confuse about that. So you making the payment direct debit doesn't mean you can submit after 3 days. You have to submit by 1 month, 7 days, that is 7th of July. But you can make the payment after 3 days. So 10th of July. All right, let's move on. Then have a correction of error. Let's look at this question. Let me see how many of you remember your level 2. This question, I'll give you 5 minutes to look at this question, activity 5, correction of error. It's very simple, but a little bit tricky. So let's see how many of us can do it. Then we solve it together. This one is quite interesting question. Obviously, I have done this thing on a level 2 as well. So they are saying, identify the balance showing on the VAT control account before the error adjusted. So if we don't correct the error, how much will be the amount we're expecting from the VAT control account? Now it is possible, like when you do the bookkeeping on the Excel or on the software, if you made a mistake, you will see the wrong figure on the VAT return. So we need to make sure we need to be very careful, especially if you work on the VAT side, because that's the only side is very sensitive. If you claim more VAT, you might end up with a penalty, and there other thing can go on as well. So we need to make sure like we don't claim the wrong VAT from HMRC. So let's have a look at this one. So if you make the T account, it will be more easier for us to understand. So it says a trader has a VAT payable to HMRC for the quarter ended 31st of March 2010, 3750, and VAT payable for the quarter ended 30th of June 2010, 4200. So for 2 quarters. So first quarter, let's see if I said quarter ended March 2010. So we need to pay to HMRC 3750, and quarter ended June, the VAT is due 4200. This amount are correct on the VAT return. So these two are correct. Trader pay the VAT for the quarter ended 31st of March. So this is the one, March 1. So the company paid. So remember, if you paid for the VAT, payment for the VAT is supposed to be on the debit side, because if you pay the VAT, the liability should go down. So your liability now 3750 plus 4200. If you make a payment, it should be on the debit side, so your balance sheet will go down. But what happened, by mistake, enter into the wrong side. So rather than enter on the debit, you record on the credit. So you write payment 3750. So once you do that, what will happen? Your balance sheet will be 11,700. So rather than 7950, it will be 11,700. So your VAT control account will show you need to pay 11,700 to HMRC because you record the entry on the wrong side. So you need to be very careful with the debit and credit. So when you do the journal, if you make the wrong entry, it will show the wrong item completely, because it's supposed to be here and you write that side. All right, any question from this one, from anyone? Anyone have any question? All right, very good. Now the VAT return, this one, I want to start next week, this session for the VAT return. And there are a very important thing we have to discuss from this chapter because we're expecting at least 20 marks to 25 marks from the VAT return in the exam. So this question itself will give you 25 or 20 marks. So we need to make sure we do slowly this question. So next week, we're going to start that. We're not going to do lesson very long today. And obviously, like next week, we will start from our VAT return from this chapter number 5. Then week after, we'll do maybe chapter number 6 and half of the 7. Then we can do 7, half, and 8. And that's how we're going to complete. And after that, we'll do one revision from the A2 website, and our course will be completed.